Hi, this is Jim Sackman from Focal Point, and this is another of our Success Friday videos talking about financing your business. And the topic this week is valuation, and in particular, that's important. Equity investors and equity investments in a business, especially we're talking about small private businesses and not on the public market. Although there's an analogy to the public market and two kinds of investors that you'll see, and really we're going to see a mix of these two. The first is what would be called value investors in the public market, and those are people that are focused on the financial metrics of a business, profitability ratios and all kinds of numbers associated with that. The second kind is a growth investor, which is really focused on the market and the market position of the company and looking for businesses that are set to expand. Now, in the private world, you're going to find everybody's pretty much a mix of those two, but in the public world, there's often a much stronger differentiation. Now, for an established business, really what we're talking about in terms of valuation is a multiple of cash flow. And that's all about how much profit shows up in a business after all the expenses and all the capital's deployed. And that's important because essentially this is an investment, and your money back out of the investment is the cash that you derive out of it, or your cash flow. Different industries have different multiples. There will be comparables and standards within an industry, and you should expect, you should target your business at that multiple of cash flow for your industry. The other part of the business that'll be adding to your or subtracting from your valuation is your balance sheet and your asset list. I deal with a lot of businesses that have substantial fixed assets for the size of their business. That impacts both their balance sheet and the assets on their balance sheet, as well as their income statement with depreciation of those assets. So all of that mixes together and comes up with GAAP financials. There's one other challenge associated with that, which is most small businesses run at least some amount of non-business expenses through the family business, and therefore there's some level of pollution of the income statement in particular with non-business expenses, and that needs to get pulled out because those expenses, while great for tax purposes, lower the free cash flow of the business and therefore the value of the business. So there's likely to be a reconciliation that needs to happen so that a buyer knows that the tax statement that's submitted and now the financials that you're trying to present, that they understand what came out, what puts and adds are added in that statement. Finally, we need to look at the growth side of the equation. We need to understand if there are some specific customers or customer segments that the business is doing very well in. The growth rate of the market, is the company exceeding the growth rate of the market it's in? All of those are important ways of trying to get a better multiple than the standard multiple for your industry. So that's the basics of valuation, and I hope that helps. This is Jim Sackman from Focal Point. Change your business, change your life, and have a great day.